Hello, everybody, and welcome back. In today's video, we're going to be talking about the Bollinger Bands. It's a technical analysis indicator. It basically, we're going to be talking about how is it constructed and how to identify trades in different financial markets using this indicator. It was developed by a man named John Bollinger, so no surprise where the name came from. So a lot of people do consider this indicator as a complicated indicator, but in this video, I hope to show you how simple this indicator really is. So let's start here. And we're gonna be drawing the sections of this indicator. Let me grab my brush. Here's my brush. Okay. So the Bollinger Bands are basically constructed out of two sections. The first one is the moving average. The second one is the bands, volatility bands. So it's going to be looking something like this. So let's say this is our moving average, and you're going to be seeing something like this. Something like this. So the bands are always located above and below the moving average. So let's start with the theory. Then we're going to be looking at the real life example on how to use this indicator on a real life market. So basically, like I said, the first section is called the moving average. It's usually a 20-day moving average. This is what we use, and the bands are located above and below the moving average. Now, always remember these bands are located 2 standard deviation away from the moving average. So, basically, the idea here is to describe how the market is dispersed and how the prices are actually moving. So basically, it tells us how the prices could be moving about 95% of the time. So, for example, how to use this indicator? It's really simple. There's two major ways how to use this indicator. The first one is the overextend zone. Now, what does that mean? We talked about a lot in a lot of videos in different indicators, the overbought and oversold zone. In this indicator, it has the same kind of concept, but it's very related to the bands. So let's change our color to red. So this is going to be the red is going to be the market, and the black is going to be the indicator, the moving average indicator. So let's say the market is actually going like this. Sorry about that. Here we go. So as you notice here, basically when the price reaches the upper end of the band, this usually gives us like a sell signal that the price has reached overbought zone and the price will drop down. So the price will drop down, and when we reach the lower end of the band, basically it tells it it's technically like a buy signal, and it's gonna give us basically a bounce in the market right now. So right here, it's going to bounce back up. This is the first way to use this indicator. It's really simple. The second way is even easier. It's called targets. And what are targets? Targets is basically when we enter a trade and we have the take profit signal at a specific target. And what does that basically mean? So, for example, let's use this point. So the band actually dropped to the lower end. So we're thinking about the price could be going up. Now, because it's very like this indicator is bounded up and down. So let's say we want to take profit here. Okay, so we set up our target at the upper end after the band has reached the lower end, and we wait until the trade goes up and we take our profits. It's very simple, but you gotta remember this indicator is based on the market volatility. So because the market volatility changes a lot, so these bands won't stay in place away from the moving average. They're gonna go further away and they're gonna get tighter. So if the volatility drops, we're gonna see these bands come tighter. If the volatility increases, we're gonna see these bands go further away. Now let's look at a real life example and let me show you how this indicator works. Let me delete all of this. Let's go here. This one. All right. So this is the daily chart for the gold USD. All right. So first, then we go to our indicator tab and we type Bollinger. Let's see it right away. And here's what it looks like on a real life market. As you can see, these are the bands in the blue line, and the moving average is the orange one. So let's look here. Like if the price, for example, let's use the first way, okay? It reached an overextended zone. So as you can see here, the price has dropped down and it reached the lower end of the volatility bands. these bands. But basically, that gives us that the market is due to increase in price. And as you can see on this live example, the market actually did jump from here all the way to here. As you can see, like most of the prices are located between these two bands. Like I said, it actually describes 95% of how the market is actually gonna move. That's the first way how to use this indicator. It's quite simple. It's really easy to understand. The second way is targets. Like I said, just the target here goes up here. We cash in our profit. But now let's talk about these bands. Like I said, they do move away from the moving average, so like they change when the volatility increase and drops, and that gives a lot of people ideas about how the trend is currently going in the market. For example, if the volatility bands are really far away from each other, it usually indicates that the trend is currently ending, so maybe it's a good time to get out. If the volatility bands actually get tighter and tighter, this is called a squeeze, and a lot of people call it a squeeze strategy. It's basically that the market is ready to do an explosive move. So let's look at a real example here and see how this goes. Let me do that, sorry. All right, for example, look around here. Okay, so look here, like how the volatility is really, really, really big, so that the bands are really far away from each other. And it basically told us that the trend is currently ended. It was a bullish trend, as you can see here, and the trend started to end when the volatility started to drop. And here, look at this area exactly. Look at how the bands are tightened together. Like I said, a lot of people consider this as a sign that an explosive move is due to happen. So notice here how the price actually went back up and went back below the moving average. And as soon as the band started to expand, we had a huge drop in the market. The actually market dropped from 1950 to the ranges of actually 1850, more than 100 points. And that's basically it. It's a very simple indicator, but I do gotta remind you, always use different indicators. Like never just use one indicator. Use different indicators when you're analyzing the market, because it's gonna give you a more accurate result in the end. And you're gonna make more profit and take less risk like this. Thank you all for watching. I hope you learned something here. Make sure to like and follow, and have a great day.